Hello and welcome to this Open Banking Expo live panel debate, Myth Busting with Those Setting the Pace, sponsored by Equifax. I'm Ellie Duncan, Head of Content at Open Banking Expo. Now, many firms have been using open banking data for some time now and haven't looked back, seeing it as an opportunity to supplement existing data and to build new data profiles on consumers. But for those yet to make that jump, there are several factors holding them back. Regulatory concerns are preventing some firms from embracing open banking data, while fear of the unknown is the reason many are hesitant to welcome the use of more data. It begs the question, is there such a thing as too much data? Open banking data myths around volume of data and possible regulatory action are slowing wider adoption. All of which brings us to our panel, which comprises industry experts from companies that have already taken the leap to adopt open banking, as well as experts from the world of regulation. Joining me today is Emma Steeley, CEO of AccountScore, an Equifax company, Luke Enock, CEO of Oakbrook, Noline Matemera, Partner Financial Services Regulation at TLT Solicitors, Sanjeev Pottay, Commercial Director at My Community Finance, and Michael Hoare, Chief Credit Officer at RateSetter. Now, later on in the debate, we'll open up to a live Q&A. So with that in mind, do send in your questions as the debate unfolds for the panel. And while I have your attention at this point, it will be great to get some feedback on today's debate. So please do, if you can, and have time at the end, fill in the feedback survey. It's the orange sort of feedback survey icon on the homepage. Plus, we'll be running 3 different polls throughout the event, so please do cast your vote in all 3. We'll be asking what are your biggest concerns with integrating open banking data into your credit decision process? The second poll, we'll be asking, is your organisation planning to use open banking post-forbearance to enable you to identify vulnerability? And the third and final poll is asking, are you considering using open banking data within your automated decision-making process? All of those are sort of multiple question answers, so do cast your vote, as I say, and we'll come to the results at the end, get some feedback from the panel. But first, I'd like each of the panelists to introduce themselves and their roles in a little bit more detail. So let's start with you, Emma.
Great, thanks so much, Ellie. Hi everyone, I'm Emma Steeley. I'm the CEO of AccountScore, now an Equifax company. So I have control over all things open banking related with regards to Equifax and how we're actually delivering it for our clients. So prior to working with AccountScore, I spent 15 years in the consumer finance sector. So well versed in understanding what lenders actually have to do in order to be able to have their regulatory responsibilities and the pressures that come with that, and how to use open banking data as part of it.
Great, thanks, Emma. And let's hear from you, Luke, if we can.
Hi, good morning, everyone. So Luke Enock, I'm the CEO at Oakbrook Finance. So I've worked in financial services for 20 years and across the globe, so half of that in the UK, half of it internationally. I have the privilege of running Oakbrook, and our purpose as a company is about personalizing and simplifying borrowing. And so you can clearly see a link between what we're talking about today and the overall purpose of the company. So I'm delighted to be part of the panel and look forward to answering some of your questions.
Brilliant. And Michael.
Good morning, everyone. Yeah, my name is Michael Hoare. I'm the Chief Credit Officer for RateSetter, the peer-to-peer company that was recently acquired by Matemera. And I look after all things credit and fraud, including our risk appetite, our credit strategy, decision engine and underwriting. And my background is all in consumer and small business lending, loans and credit cards.
Great. And Noline, let's hear from you.
Good morning, everybody. I'm Noline Matemera. I'm one of the partners in TLT's financial services and regulatory practice. We're very much in the heart of financial services regulation as a team. I started my career at the regulator, so I have spent some time in the General Counsel's division. So I have the benefit of being able to sort of see the experience from the regulator's perspective as well as from a customer's or a firm's perspective. So we should hopefully have a very interesting debate, just looking at where the regulator is going, its position around the use of data, and just the general direction of travel from a regulatory perspective.
Great. And last but not least, of course, Sanjeev.
Right. Sorry, apologies for that. Good morning, everyone. I'm Sanjeev Pottay. I'm the Commercial Director here at My Community Finance. I look after all things pricing, customer experience, and that's where I've taken a big part of the role in terms of implementing open banking and helping our customers in the experience and automating some of the decisions we make off the back of it. I've over 15 years experience in consumer finance across cards and loans, and look forward to discussing this more.
Great. Thanks everyone for joining us, and let's get underway, because I know we have plenty of questions to get through, and I'm sure plenty more will come in from the audience. So I think it's fair to say that the take-up of the use of open banking data in the UK has been somewhat slower than expected. Noline, I want to come to you first. Do you think this is due to lender concerns over regulatory fears?
I think that's a fair starting point to say that there is a degree of lender concern and worry, and where's the regulator going in this? What is the regulator's likely stance? And I guess the answer to the question and the lender's concerns is really looking at the FCA's business plan for 2020-2021. If you look through the business plan, there's a very clear theme that runs through it, and one of the things that the regulator is very clear about is there's an expectation that they're looking for open banking to increase and hopefully actually evolve into the concept of open finance. So it's going beyond just open banking. We're now thinking about open finance. And the regulator's view is this will facilitate greater competition. And if you just think outside of the commentary around open banking, there's also quite a fair amount that the regulator says in the business plan around its own data strategy, the use of big data, the ethical use of data. So really off the back of that, I'm more minded to say there is an expectation that the regulator is open and encourages the greater use of data. So really there shouldn't be that reluctance and fear, because if you were to look at just the general mood music coming out of the regulator, there's an expectation of an increase by regulated firms in the use of data rather than a decrease. So really, yes, there is a degree of reluctance, but if you were to follow the regulators leading, the expectation is there should be more rather than less use of data.
Emma, I want to bring you in here. Do you agree with that? Is that what you're seeing?
Yes, absolutely. We are clear that the regulator is not neutral when it comes to open banking, open finance data, and are encouraging the lenders to use it. But I think, where if you're thinking about it from a lender's perspective, I think there has almost been that reluctance to use it because it's about using a data set that they haven't had to use historically, and so you can't retro open banking data like you can with CRA data. It's consented data, so you're collecting it in real time. So the lenders are looking to go through the processes of learning how to actually use the data and understanding what returns it can actually drive. So it's not about saying, we're going to see this transaction and that means that we just can't lend to the customer. It's about looking at it in context, and it takes time I think to go through that process and really get to the understanding of the data to then truly implement it strategically across the organisations. And I think that's what we're when we partner with our clients, it's really about working with them to understand the benefits of the data as opposed to potentially having that fear of the unknown.
Yeah, absolutely. Luke, can I bring you in here? And do you see that evidence of that kind of fear of sort of the regulator and this kind of unknown quantity, if you like?
Yeah, not to repeat what's already been said, but I would completely agree with comments from Noline and from Emma. I mean, I'd position it like this, which is using transactional data in credit risk has been around for decades. When I first started, 20 years ago, we were using transactional data to make credit decisions. I happened to work for a universal bank that had access to that information, right? So the concept of using that data and the concept of that being really powerful in making better, more personalized decisions for customers has been around for decades. The challenge has been when you're outside of the big universal banks, how do you get access to it? Which was, the big thesis around why open banking came around. Now, the real challenge for most lenders is the fear of the unknown. And Emma hit the nail on the head, which is the modus operandi for all credit risk areas that I've ever worked in. I've had the pleasure of leading those teams in the past. Is they love control. They love to know precisely what the outcomes are going to be. And therefore, the modus operandi of having a retro data set, looking at had you had that information in the past, this is the outcome you would have achieved. Now, unfortunately, that is not something that's available in open banking. And therefore, everyone has to go on a journey to evolve to a new way of working. And that creates fear, reticence, etc. And all I would encourage all the listeners to do is the very premise of transactional data being incredibly powerful is indisputable, really. And therefore, if you there's a famous saying, isn't there? If you want to achieve something that you've never had, you need to be willing to do something you've never done. Right, and I think that's really apt for credit risk folk. They need to be willing to do something they've never done, which is learn as you go through a process, as opposed to having full sight of what the outcome is going to be, which is the historic modus operandi.
Okay. I like that quote. Very, very nicely inserted there. And okay, so more broadly, then let's open it up. Beyond the kind of concerns about sort of regulation. More broadly, what do you think is the major hurdle or blocker, if you like, for the take-up of open banking in the lending space? So, Michael, let's hear from you on this.
I'd echo some of the, well, I'm not going to repeat some of the things that have already been said. I think Emma's point around the retro is a key one for credit risk folks like myself. We obsess about getting that historic data and being able to understand what would have happened, as Luke said. I think the other thing I'd call out is, this went live in 2018. The big guys, the CMA9, and then some of the other ones that followed soon after were I think focused on their side of the bargain, the supply. Building those APIs to supply the data, not necessarily how they were going to use the data from the rest of the banks. And so I think there's a case of prioritization in those early years that didn't happen with some of the big guys. And then some of the medium and small lenders that weren't providing the data then had a question around, can they fit it into their roadmaps? Are the APIs stable? Is there adoption? And therefore, does it answer enough of a question for them to spend the time, to spend the tech resource? And I think those lenders that had always been using the older technologies like screen scraping probably already knew all the value that they were going to get for it and would have been very, very quick off the mark. Those who hadn't had those other questions to consider around, I've got regulatory things I need to do, I've got other investments I need to make. Where does this sit in my list of priorities? And I think some of them will have played a waiting game to see whether that adoption from the consumer was going to be high, whether the APIs were going to be stable, all those kinds of things. And so I think you've got a list of people who have taken their time about when they were going to adopt it, when they were going to fit it into their roadmaps.
Sanjeev, I'm keen to bring you in here and find out what you think in terms of, what's this major hurdle, do you think, that's holding back kind of wider adoption?
I think, a lot of the points have been covered. I think the pertinent one is the retro and the retro data. Having worked with credit risk or lending for quite a while, that is a massive unknown for a lot of companies. I think the other piece of the coin is the complexity of this data and how you use it and the unknown. How do you actually go about where you haven't got that data? How do you go about thinking through the problem set? And I think that's where partnering with people like AccountScore, who've been in that position before, can give you a lot of value. and advice. And I think that's certainly what we did when we got into the open banking journey. We could certainly see there was value from a customer perspective in improving the journey. But how do you actually start that journey where it is an unknown? And testing those ideas with people who've worked in the market has been insightful for us. We've now just gone through 12 months of having open banking within our journeys, and we're now starting to adjust the rules and the decisioning off the back of it, which is has been a journey, and now we can.
Yeah, Emma, AccountScore was mentioned there, so I thought I'd bring you in and just find out kind of your thoughts as well on this, the idea of partnering and how perhaps that could overcome some of these obstacles.
Absolutely, and I think that there were sort of misnomers around when open banking first launched. I think we all sort of collectively as an industry worked very hard to make sure that ultimately those APIs became stable. When app-to-app redirection came in, we launched it in July 2019, and that increased conversion by 10% overnight. So we kind of work with our clients along the journey. But yeah, very much from my point of view, all data is not equal. Lenders are very surprised when they see raw bank transaction data for the first time. It's very different than when we used to get bank statements faxed in and we used to go through highlighting, and underwriting in that way. So, what you need to, working with the industry and getting the understanding in and around income and affordability in the data is key. And then the other piece that I think has been a blocker has also been the adoption of the brokers and the aggregators, which we definitely started to see a big shift in 2020. So, whether the world likes it or not, majority of the traffic that the lenders receive come from the broker market. And so you needed the lenders to have already adopted open banking, so it was compelling enough for the brokers to then put it in their front end and to be able to pass that data over. So I think that's been the other hurdle. And then so the technology being in place to overcome that, I think has been key and has helped to unlock a whole another area and start to increase those volumes when it comes to making the lending decisions and a better consumer journey.
Yeah, obviously that's what it's all about. And just to say thank you, we've had loads of questions already for the panel, so thanks for sending those in. Do keep them coming, and we will answer them sort of after the main part of the debate. And something you mentioned, Emma, was sort of data giving an insight into people's income and so on. Another problem that perhaps it can help with is where you see kind of gambling issues among consumers and so on. I'm just wondering what level of kind of gambling spending, if that's been identified within transaction data, would be considered to have an impact on a consumer's sort of credit risk. Noline, this might be something that perhaps you can feed into here. Are they likely to expect sort of regulatory problems from FCA or FOS if a lender approves someone for credit who they can see has some level of kind of gambling spend?
I think the key word I would use here is proportionality, because the nature of human interaction is you will come into information that you didn't expect. And really what the regulator's expectation there is to be able to make an objective assessment of the information in front of you. If we're talking about the odd transaction that is not material, then, you need to attach the appropriate value to it. But if you see something that suggests a systemic issue, a systemic concern, then obviously the reaction will need to be different. So really, I don't think it's a case of the moment you see a single gambling or elaborate transaction, if you want to call it that, I don't think that's necessarily a requirement for you to take to the hills and not actually interact with that particular potential customer. It's really looking at all the information in front of you, all the data fields in a very holistic way. What does this tell you about the person? What are the trends? What are the themes? What is the broad picture looking like, rather than just picking a single data field, because then, the real value of the data is somewhat undermined by making a buying or rather a lending decision off the back of a single line of data. So really it's I think it's almost coming away from the comfort of prescription. And I think that's one of the challenges that we're finding in this space. Regulation has traditionally been quite prescriptive. You've always had policies, procedures, hearty chunks of the handbook that set out line by line what needs to be done. The challenge in the open banking space is the absence of that degree of prescription. Even when you look at things like affordability, there's a lot of guidance and commentary, but there isn't a list that says if you check these 10 points, you are fine. So I think there's probably a piece around being proportionate and considered, and also I think just being confident in some of the decisions that lenders are making. If you can justify your decision, and if you can set out the thinking behind why you thought this was a good lending decision or otherwise, that should suffice. And I think it really is about being comfortable to make the decisions and explain the rationale should you be challenged by the FOS or the FCA.
Luke, is that important, do you think, having that holistic view of data, and being able to have the confidence to kind of put forward any decisions you have made to the regulator should they ask for them?
Yeah, I mean, I know we're focusing a lot on the regulator, but I would say it's broader than that. It's to ourselves as well. Right? And there'll be no one sat on this panel who wants to lend to customers who who can't afford to repay. Right, so it's not just about doing what's right for the regulator. A big part of the regulatory regime, certainly as you think about SMCR, is about culture. And again, the right cultures in companies. And knowing my esteemed colleagues across the panel here, I know culturally there will be no one here who wants to lend to anyone who can't afford to repay the loans, right? And so, but going to the very specific point around gambling, I mean, one in two adults will have gambled in the last 4 weeks. Right, that's the Office of National Statistics stats, right? So it's something along those lines, and so it's not the presence of gambling that is per se the challenge. It's problem gambling, and that being a sign of vulnerability. And I think if you think about the overall package of what the transactional level data will give you, is a far greater insight to spot signs of vulnerability and then take the appropriate action as a result of what you see. And so gambling is just one facet of identifying vulnerability. There'll be a range of others, things like more recent loans or credit agreements with other lenders in a very short period of time. It could be sudden changes in income or other circumstances that you see through the transactional data. So there's a whole range of things. And to Noline's point, it's not just about the one, it's around the package. And so I would encourage the listeners to think about it as a what are the themes that you're looking to identify, and how you create that overall perspective for an individual customer. And it comes back to that personalization for that individual customer. How do you assess the circumstances, and then how do you take the appropriate course of action?
Okay, I think it sounds like then in that sort of instance, there's no such thing as too much data in a sense, because you want to get this kind of holistic overview rather than focusing on kind of one transaction. But there is also perhaps a theme that has come up where there is, an abundance of data now. So I'm wondering, does any of the panel think that having access to so much data is a bad thing? Emma?
Well, from my point of view, more data means better decisions. So embrace the data. I think that it definitely means that yes, it is easier to say no to a consumer, but you're saying no for the right reasons. So therefore, that is a good thing. But also, when you really understand the data, you're able to say yes to more people that you may have said no to before. So it really does drive the financial inclusion. So yeah, fundamentally for me, very simple answer: more data is better decisions. So I don't think there is such a thing as too much data in this instance.
Michael, is that something you agree with? Where do you stand?
Unequivocally, more data is better for a credit risk decision. Absolutely. But there's a distinction between the data that you use on an individual customer and an applicant and all the data you capture and store to periodically reassess and reoptimize your strategy. So on a particular applicant, you will gather, a typical lender will gather somewhere between, I don't know, 2,500, maybe up to 10,000 pieces of information on that applicant. But they're not using that many for that in that moment. They'll probably use somewhere between, I don't know, 100 and 200, and that's it. The other, God knows how many, are then used periodically to reassess whether those cohort was a good idea or not. And then you might flip out 20 variables and put in a new 35. The challenge comes when anyone in retrospect looks back at a particular application and says, okay, I get that you use these 80. What about all the other information that you didn't use? And it's very easy in retrospect to paint a picture, said, oh, well, we found this little piece of information. Why didn't you consider that? And it's very difficult at scale in an automated way to optimize for that, almost auditing in hindsight. But more data absolutely is the way to go.
Okay. So I think we're all agreed that more data is better. I wanted to kind of follow up by asking first, Sanjeev, how are you using open banking to kind of reassess any credit policies or improve your own credit decision making?
Yeah, so I think this is the pertinent one. I think obviously the first instance of open banking really helps you with affordability, and as Luke alluded to, your vulnerable customer sort of decisions, and those are really important to look at. And it's something that, as I said, is quite complex when you start, but you think that through methodically in terms of the impact to the customer, and you can get to those decisions quite quickly. As we've now been doing this for a while, we have been able to go back and, as Michael alluded to, almost go back to the data that we collected and revisit some of our credit decisions. And I think go forward for us, it's probably a risk-based scenario for us about how we use open banking, which where that customer is on our risk spectrum, and how much value that data adds to the decisioning. And I think that's probably the way forward that we would sort of starting to look at, is where can we add extra data that helps us to make better decisions in our credit underwriting processes right now. And I think it will depend where that customer sits on our risk spectrum.
Luke, have you kind of used this data to help improve your own systems and decisions?
Yeah, of course. So I think we've been using open banking data since probably 2018, but I would argue in a fairly niche way. The pandemic, as that started to emerge in March last year, was as an accelerator for us. So we've probably packed in 5 years worth of a roadmap into 12 months. And the vast majority of all our applicants now go through open banking. So we're heavily weighted towards open banking as part of our underwriting, and we use it for a whole package of things. So I've talked about the vulnerability. We've talked about affordability, but again, I'll go back to the very first thing that I said, which was, banks have been using this data for years, right? And the way in which most applicants were funneled when they came into one of the universal banks was: is this a customer we know? Is this one of our customers, or is this a completely new customer to us? And if it was an existing customer, then they would go down a different credit strategy, which typically relied on being built from transactional level data and other sources of information across the bank about that customer. And when you do a side-by-side comparison of those two underwriting paths, the scorecards were always significantly superior when it went through a known customer journey. And so this premise of it's going to be more powerful in your credit arena as well is absolutely there. right? So it's been proven over decades. The challenge for all lenders is we're starting from scratch, and so you've got to build up that knowledge and that base. And so we're 12 months into really using open banking in anger. I would say that in the next 12 months, you know, a lot of our scorecards will be certainly augmented with integrated open banking. Today, it's used more as policy rules, but I suspect within the next kind of 6 months, they'll be far more augmented with open banking data. And you know, there's no skipping that hurdle, right? You're going to have to learn your way into it, and it's going to take time. The longer you leave it to decide when you're going to start collecting that data and using that data, is when the clock starts on your journey. So we absolutely will be using open banking as a core part of our strategy going forward.
Okay, let's come on to kind of talk about one of the other, I guess, hurdles is trust. That seems to be a kind of a word that comes up quite a bit when talking about what might be holding back lenders from adopting open banking. Emma, you know, is that correct that most lenders perhaps want to dip their toe in the water first before kind of jumping right in, as it were, and fully embedding insights via API across the user journey?
I'm not sure that trust is really an issue when it comes to the lenders. I think the lenders respect that this is a verified data source that's come direct from the bank. So I don't think there is necessarily a trust issue from a lender perspective. I also believe that from a consumer perspective, that as long as the value exchange is there, that the consumer then feels comfortable to share their data. And that's proven in the stats that we have with regards to consumers completing the open banking journey in a lending scenario. You know, it's pretty much an 80% completion rate. So when there's that value exchange, the consumer trusts and engages accordingly. Now, what we have seen, certainly when open banking first started in 2018, right through to probably Q4 of 2019, it was very much sort of our sort of turnkey style POCs that the clients wanted to utilize just to start to get to grips with the data and really get that understanding of the data. Now, we really saw that shift, you know, app-to-app redirection coming in, I think really helped that shift. And then you know, really the lenders started to build it into their strategic models and moved more towards that API journey. But whether they are implementing an API or whether they are doing manual underwriting, it certainly is a case that in terms of dipping the toe in the water, they're more likely to use it on referrals or marginal declines in the first instance as they get comfortable with the data before moving it up the journey to make it a mandatory part of the process.
Okay, yeah. Michael, do you see that happening as well, a bit more, getting comfortable with it before kind of implementing it completely?
Yeah, I mean, the obvious use case that you can do on day one without needing a retro and without really needing to get too into the weeds of the data is on income verification. And I think you could just get going on that right from the outset. There is an element after that about credit risk folks, you know, very cynical bunch wanting to sort of wallow in the data and get you before they really embed it into their, you know, scorecards and their decision engines. But the way is, as a lender, if you can avoid adding things into the application journey, you will. If you can make a decision just asking for their name and address and nothing else, and get, you know, a decision back in milliseconds, you're going to do it. So I'd echo what I think Emma was just saying on. I think most lenders will implement it to answer a particular use case where they can't currently automate the decision. So if they're going to refer, for example, for income verification, or if they might otherwise have said no, they'll add that element into their application journey. Because you know, I think the journey is it doesn't add a huge amount of friction, but it adds some friction. And most lenders are obsessed about their conversion through their digital app journey. So if they can avoid adding it, they will. But I do think it'll become quite very common, because I think it will answer a lot of use cases in the future.
Mm-hmm. Yeah, you mentioned there about perhaps that first port of call is income verification. And I mean, I guess there is this idea that open banking data can help perhaps the on those that do have a more kind of variable income now. Luke, what do you think of this? And is it sort of the missing piece of the jigsaw for the economy that we hear so much about?
I don't think there's any panacea for these things, right? But open banking does provide you with real-time information around income, and for that group that you've talked about in terms of variable income, so income that changes. I would say all those that have already started working with open banking will probably appreciate what I'm going to say, which is, as you get into the data, there's probably an assumption that everyone's got this kind of standard, this is my income, and I get it every single month, and it's really easy to say this is someone's income. I promise you that is rarely the case, right? Actually, the vast majority of people, their income changes from month to month. And that can be anything from, there's business expense that's reclaimed and paid back through the income. It can be bonuses, and bonuses have a whole manner of variability through to multiple jobs. And so the actual challenge is, how do you create income algorithms that deal with all of these different scenarios? And so for us, we spent a huge amount of time manually underwriting effectively applicants. So everyone who went through open banking, we manually underwrote them all. But what we did differently was we had all the credit risk and all the decision scientists sat with the manual underwriters, trying to figure out all the different permutations and scenarios and building algorithms for those things so that we could eventually automate it. There's no shortcut for that. It takes a lot of time and a lot of effort, but it's a lot of fun, and it creates a level of collaboration between kind of operations area and credit risk and decision science, which typically don't get to interact as much as certainly I would like. And so yes, it can absolutely help, but there's no shortcut to how you get there.
Okay, Sanjeev, I could see you nodding along when Luke was talking about, this idea that everyone has a set income every month, and it's just not true at all. So perhaps you can speak a bit from your experience and sort of how open banking data can help lenders when you do have those consumers where, the incomings and outgoings each month really fluctuate.
Yeah, I think what Luke said was quite relevant to what I've experienced, to be honest, sitting around with the credit underwriters and the ops guys and the credit risk decision guys, and we've been optimizing the rules all the way through as we, open up and you come across unexpected scenarios. So that is one key point about implementing open banking. You start and then you sort of rapidly optimize and implement as you see the real data come in. So I think that's a big point. On these customers where we have inconsistent income, as I said, I don't think it's a panacea. I think what it really does bring up when you start to look at this data, and you'll start to pick it up as you go along, is it starts to help you potentially develop new products for these customers. Is there a different way to service these customers? Is a different way to get to them, and is a different product that works better for them rather than the current sort of vanilla type products that we have in market? And I think that's where really the data could and the information that you get really help hyper localize a product that really hits a sweet spot for these customers. And that's where I think there's an interesting angle for open banking, especially if you can continue to get that data from the customer over the life of their relationship with you.
And interesting talking about this on this particular topic of kind of inconsistent income. I mean, a few of you have obviously mentioned the pandemic, and one of the things that happened last year was obviously the start of the furlough scheme, and that's in the UK. The furlough scheme is due to end in September. I mean, what role, Sanjeev, does open banking play in ensuring lenders can access, just a more accurate assessment of affordability, given that many have not only experienced in the past year an extremely sort of variable financial circumstances, but we're about to come, as I say, to the end of this furlough scheme. It's quite a critical point, isn't it, really, for many consumers and for lenders?
Yeah, I think it's been the accelerant to the adoption of open banking. I think if I look across the room, the guys in this panel, we all know, that has been a massive accelerant. As we weren't able to get the assessment on income. Most of the bureaus were looking at 12-month averages, which weren't that relevant to that situation of the customer at that point in time at the start of the furlough scheme and the COVID pandemic. So that's been a huge accelerant, and we've seen real value in getting real-time look at the customer's situation, and that's helped us feel much more comfortable about the lending decisions that we made. I think a group of other groups of lenders went through sector-based approaches, which I think has been interesting as well. Not lending potentially to certain sectors, but as we start to come out of COVID, you can start to analyze these different sectors that, some might say are high risk because there's more furlough customers in those sectors. You start to see that in the data as you start putting them through open banking, is when's the right time to start reducing the focus on those sectors. That's quite interesting. That's sort of leading the charge of how do we start opening up and servicing those customers again, which I think is going to be interesting as we come out of it.
Yeah, absolutely, Emma. Can you build on that? And because it has been a kind of I know we've heard this word a lot, but it was such an unprecedented set of circumstances, wasn't it? And a lot of people are still in the furlough scheme. So what are you seeing on that front, and how is open banking helping there?
Yeah, I think it's really important to understand if the customer has been furloughed, and you can easily tell that, and you have actionable insights within the data sets as well to identify if a customer is potentially being furloughed. But what is critical is as we do come out the other side of this and the furlough scheme ends, is actually truly being able to understand within the categorization of the data when it comes to affordability. So what is paramount for me is about what is essential spend and what is discretionary spend when it comes to categorization, and be able to truly calculate the affordability, so the net disposable income of the consumer. Because just because somebody has been on furlough, it does not mean that their expenses have increased. They may have had more disposable income than they had before. So really, it's about looking at the data as a whole and really being able to get those views, as opposed to just having a one size fits all. Oh, okay, this industry, this means that I'm not going to lend to, or this person has been on furlough, so I'm immediately going to say no. The joy of open banking is that you are able to personalize the products and the offering that you're giving to your customers, because you are seeing those individual circumstances. And of course, there has to be credit risk rules across the board, and you'll have the policy rules, but it really is about kind of looking under the bonnet, in my view, at really trying to see how you can utilize this data in the right way to deliver those personalized products. And just because somebody's been furloughed doesn't mean that it's a closed door.
Okay. Well, we've had plenty of questions coming in, and just a reminder as well to the audience that there is still time to vote in those 3 polls that are running, so please do that. I'm just going to bring this part of the discussion to an end now, and maybe put to you a few of the questions that have come in from the audience. So the first of these that I'm going to be asking, it's fairly long-winded, but stick with me on it. So someone has asked, is there a challenge with limitations of the transaction data available from certain account types? For example, joint accounts. What might the solution be to attributing certain transactions to your applicant? And the kind of additional question they've asked there is that for those customers who share multiple accounts, what might options be to prevent a single income stream being categorized as salary income multiple times? So, Luke, if you got all that, what can you answer that one at all?
Yeah, of course. Yeah, so the short answer is yes, there is a challenge. So there's a challenge for joint accounts. There's a challenge for self-employed customers in particular. And again, there's no quick answer to how you solve those. The way in which we do it is, unfortunately, we have to manually underwrite these. And repeat the same process, which is the hard yards of then getting the decision scientists, the coders wrapped around it to understand how would you build algorithms that replicate what a manual underwriter is doing. I'd love to say we've cracked the code on that, but we absolutely haven't. There's just a lot of hard yards still to be done in that space. But Emma knows this all too well, because it's kind of some of the conversations that we have as Emma works very closely with Oakbrook. So yeah, it's part of the challenge, and still some hard yards to go in that space.
Emma, did you want to add anything on that?
Yeah, I mean, what I would say is, you are collecting the application form data as well. So, if you are asking for the employer name and, in the joint account, you're seeing that employer name go in, then I think that gives the ability to be able to at least start the journey of identifying the income of that applicant. But yeah, to Luke's point, it isn't the easiest thing in the world to do when looking at a joint account. When a customer is sharing multiple accounts, you are always going to ask for the salary account first. So as long as you can see the income going in, you are then able to see the transfer to a different bank account. And maybe if the customer is only transferring 10% of their funds, maybe you're not concerned about that. If they're transferring 50% or more, you're likely to want to look at that account. But actually, if you have it in place that the customer can add the multiple accounts, and as long as you're seeing the main salary account first, you can see those transfers going out. So therefore, you should net off the income in the additional accounts.
Yeah, Emma, I was just going to add one thing, which is that there's an additional challenge with joint accounts and open banking as well, which is if a customer gives consent for you to go and collect that data, some of the banks have taken the view that the other account holder would also need to give consent. And in the moment, it basically fails. And so there are many open banking transactions that basically don't get fulfilled because of that consent issue. And that happens a lot. So it's one of the challenges that we've got to solve as well, is how do you make that more seamless, where joint accounts and the API calls go through and consent is already established.
Okay, let's go to another question so we can get through a few more. Michael, perhaps you can take this one on. How do we get better uptake by SME customers?
SME customers. I mean, one thing I don't think we talked about a huge amount earlier on was how well known open banking actually is amongst the general population. And I think that is a potential, or I think that's a big problem for uptake, not least because financial services companies, tech companies, the whole range have over the years slammed home the message, be wary of new things, be wary of links, be wary of emails, be wary of this, that, and the other. I don't think there has been a sort of a campaign to get open banking as a brand or as a concept right in front of the average consumer to say, look, this is a thing, this is a positive thing, you can trust it. And so, it doesn't answer this question, but going back to the sort of one of the earlier points, I think that is potentially holding back some of the end customer adoption. And then I think the reason I bring it up is because I think it then relates to sort of your average SME customer. Why would they adopt it? What is it in? What is in it for them? And I think they need to become, your average consumer needs to become much more aware of what open banking is and what it can do, and then that can then filter across into the SME sector. And then I think lenders have to provide a rationale for those businesses to provide the data. What is it in it for them? Why would they share all of this data? If they can see a value exchange, if we can get the message across around, you're more likely to be approved, you're more likely to be approved or decisioned faster, then I think that can provide a valid reason why they would want to adopt it.
Mm-hmm. Okay, and we've also had a question specifically on kind of utilities. So someone's asked, how can open banking affect utilities companies where you can't choose your customers, you inherit them and their spending habits, of course. How can you encourage these customers to take up and agree to open banking, and not just when agreeing to long-term payment plans for debts? Sanjeev, maybe we can bring you in here, and I don't know if you've got a view on this.
It depends on the use case. I think it always depends on the use case and the value exchange that you give to the customer in that open banking. As Michael alluded to, what we've seen is a great uptake in adoption of open banking for us. And where you place it, I think, in your value chain, in that value exchange is really important. And what they get out of it. We've really focused on the speed of execution for the customer, and not having to bring in to send in manual PDFs is a massive win for the customer in terms of that ease and friction getting that information in when you're verifying income. So I think it's really about hammering home that value exchange for your customers, saying why is this better? Why is it better to give you the information? Is it better pricing? Is it better speed, efficiency? Customers, I think nowadays customers have shorter attention span. So anything you can do speeds up that journey really makes a difference for the customer. That's how I would go about it.
Thanks, Sanjeev. And we've had a question specifically on sort of regulation directed at Emma, and I'm also going to come to you, Noline, of course. But they're saying, to Emma's point, that the regulator is encouraging lenders to use open banking. Should the FCA not be insisting on open banking usage to create a level playing field, as some lenders using open banking are being actively selected against for using a more compliant, responsible process, which involves an extra step in the process by providing the customer a link?
Well, it won't surprise you to know that I'm going to say, of course, I think the regulator should mandate this. But I think in terms of how the lenders engage with it, you are always going to get those customers that you want to have on that frictionless journey. And that is always a go-to scenario. And I think it will continue to be so for quite some time. Now, where you talk around the extra step in the process by providing the customer a link, I think that's the piece that can actually, be eradicated to a certain extent. Yes, of course, there is the requirement for the explicit consent, but it doesn't need to be done as a link. If it's embedded into the journey, that makes life a whole lot easier. And as I was saying earlier as well, there is that element now of the brokers and the aggregators adopting open banking. And as they adopt open banking, they are then able to onward data share as well with the correct consent from a GDPR perspective, that data to the lenders as well. So actually for a consumer, it's a easier journey than having to go through open banking with a broker and then, they get to the lender and then the lender asks for it again. So I think that, yes, I think the regulator is moving in that direction, as Noline discussed earlier with regards to the plan. But I don't think that there are opportunities to improve that user experience by doing post or by doing an iframe.
Noline, it seems a good point to bring you in here.
I'd agree with what Emma said, to say yes, I think there's clear merit in data and the use of open banking. The only slight, I think, twist I'll put to that is it's difficult to justify making its use mandatory, because I think open banking is an aspect of how firms are carrying out a regulated activity, and the FCA's focus, any regulatory authority's focus, is the activity, which is lending. And so if you're able to provide lending within the framework of regulation, with or without open banking, that's fine from the regulator's right to supervise what a regulated firm is doing. To actually go as far as to say they must, I think that might be a step too far. And there are challenges around accessibility and cost and so on. So as much as we all agree about the benefits, there is difficulty in making it mandatory to use open banking.
Luke, I know you're keen to jump in here.
Yeah, so I guess my view would be I don't think the FCA should and the regulator should need to make it mandatory, right? For me, this is a question of leadership, and I think the challenge that we've talked about with all of this around the fear of the unknown, how complex it's going to be, etc. This boils down to, for me, purely and simply a leadership challenge. And how you want to operate your business in the future. We've laid out our stall, which is we want to simplify and personalize borrowing, right? And we use the word borrowing because we take the spin of it's all about from a customer's perspective, as opposed to lending, which is what we do. And it's really important because today the world of decision making for customers is opaque. They don't understand why. And the reality is no lender really explains why they've been declined or even why they've been accepted. And I think if you were to actually ask most customers, did they even know an affordability assessment has been done? Most of them would say, I don't know, because it happens behind the scenes and really quickly. So I think the whole premise of lending responsibly and building partnerships with customers is a leadership challenge, and open banking's got a massive role to play in that space.
Okay, thanks, Luke. And let's find out how the audience has been voting in the polls before we kind of close off today's panel. So our first question that we asked the audience, what are your biggest concerns with integrating open banking data into your credit decision process? We did have 54%, who said identifying income and expenditure when using a joint or multiple accounts. 31% said realigning my credit risk policies to take account of new data sources, and 15% voted for more data could mean a reduction in credit approvals. Then we asked, is your organisation planning to use open banking post-forbearance to enable you to identify vulnerability? And 43% said, yes, I'm planning to use open banking in 2021. 33% are already using open banking to do just that. We did have 24% who said no, they haven't considered using other data sources yet. I don't know if that's a surprise to anyone, but finally then we asked, are you considering using open banking data within your automated decision-making process? And 43% said, yeah, planning to implement open banking data into my existing automated decisions in the near future. 24% already doing that, and 33% don't use automated decisioning yet. So that's hopefully given you all a bit of an insight into where everyone stands at the moment. Unfortunately, we don't have any time left at all. That brings this panel debate to a close. So Thank you very much to all the panelists, Sanjeev, Michael, Noline, Emma and Luke, for joining us today and for that stimulating and lively discussion. If I can ask the audience again to complete that feedback survey just by clicking on the icon, you'll see it at the top of the page on Swapcard. We'd really appreciate your feedback on today's panel debate. Special thanks to our sponsor Equifax. And finally, of course, thank you for watching. We hope you've enjoyed the debate. Goodbye for now.